It doesn't matter whether the SDR booked the meeting from third-party data or whether the person came in from a content download or whether it came from a demo request or whether an AE happened to meet someone at a meeting and reach out. It doesn't matter where we got the pipeline. What matters is that we got it and that account is in pipeline, and how much did we get and how much did we spend and what does that look like compared to last quarter and the quarter after that, and does this meet our CAC target and are we on track for our profitability? These are the things that matter when it comes to creating a structured plan for 2025. And then after that, bring in the other data that you have to be able to think about where should it come from. I'm highly suggesting that you don't say 40% comes from marketing and 30% comes from SDRs and 20% comes from AEs and 20% comes from partner or whatever the math is. I am actually recommending that you do not do that. The topic that I want to discuss a little bit, because we're talking with companies and this is like the beginning of the initial planning for 2025 that's happening right now. Most companies want to be able to have a preliminary 2025 plan ready by the end of the Q3 board meeting, the Q3 closed board meeting. And so a lot of those initial like budgeting and estimates and things like that are happening right now. And one of the things that I see consistently that I'm trying to help people look at in a different way, and maybe that will allow them to see things in a different way, is that there is a distinct fundamental difference between the idea of key performance indicators and attribution. And being able to understand these two things, because companies will take attribution and bring it into their forecasting and planning and modeling, and it creates all these other issues and complications, and you spend a lot of time debating the model and the departments and all these things, and you lose sight of the bigger picture. And so, to be clear, attribution is not going to tell you how fast an opportunity converts from a meeting into a qualified opportunity. Attribution is not going to tell you how many qualified pipeline opportunities you need to win a close one customer. Attribution is not going to tell you how much your cost efficiency metric is to be able to plan how much money you have to spend to create pipeline, or how many reps that we need to close a specific amount of revenue, or what our per rep performance is, or what our quota attainment is. These are all core KPIs that we can use in our revenue factory that have nothing to do with attribution, that allow us to plan a lot more accurately in a unified way and a lot more objectively than breaking it down and saying marketing needs to source this amount, SDRs are going to source this amount, we're going to get this much self-sourced from AEs and things like that. Because what you have is you have basically the attribution model being the difference in the planning. And the reality is, as a business at the highest level, it doesn't matter whether the SDR booked the meeting from third-party data or whether the person came in from a content download or whether it came from a demo request or whether an AE happened to meet someone at a meeting and reach out. It doesn't matter where we got the pipeline. What matters is that we got it and that account is in pipeline, and how much did we get and how much did we spend and what does that look like compared to last quarter and the quarter after that, and does this meet our CAC target and are we on track for our profitability? These are the things that matter when it comes to creating a structured plan for 2025. And then after that, bring in the other data that you have to be able to think about where should it come from. I'm highly suggesting that you don't say 40% comes from marketing and 30% comes from SDRs and 20% comes from AEs and 20% comes from partner or whatever the math is. I am actually recommending that you do not do that. But for most companies, that's what you've been doing for the past 5 years. And maybe this year isn't going to be the one that you change it. And maybe you're going to stick with that. I've mentioned for a couple of weeks that marketing does not book meetings and create pipeline for the most part. Marketing collects first-party signals from owned assets that allow BDRs to make cold calls and get meetings, or to do outreach and get meetings. And so it's not like when marketing gets sourced something through the website that you didn't need the BDR. You still have to pay the BDR in the meeting. A certain percentage of them, they're still not going to be able to convert. And so the idea that one thing came from marketing, the other came from SDRs, and the other came from AEs, Just doesn't make sense. Another part of when you look at marketing just as what did marketing source, marketing can deploy investments across the entire customer lifecycle to get the biggest impact on growth and ROI. So potentially the biggest use of marketing dollars for 2025 could be putting stuff together for your current accounts to boost GRR and NRR. And spending allocating $2 million from Google Ads and moving it into customer marketing could be like the most effective, important thing that you could do for your business next year. When you score marketing on sourced pipeline, you make that fundamentally impossible. A CMO cannot move that money over there when they're scored on sourced pipeline. And so what you're doing is you're taking the marketing function that can be used across the entire customer lifecycle, and you're segmenting it off to sourcing trackable leads. And that's why you see a lot of marketing teams don't invest in active pipeline marketing. Most companies don't invest significantly in customer marketing because the marketing KPIs that have to do with pipeline production and attribution don't allow you to do that thing or don't incentivize you to do that thing. And so at a high level, we need our go-to-market KPIs. Our go-to-market KPIs have nothing to do with attribution, have nothing to do with attribution models. It doesn't have anything to do with the departments. We're running a revenue factory. It has to create pipeline, close new logos, renew accounts, and expand customers. Those are the parts of the factory that need to happen. We can deploy investments across those, and we understand the conversion, the time, the cost, and the economics across each part of that very simplified process. Every company that has sales opportunity data can come to a view that's similar to this. And that will tell us, are we doing good? What is the current performance and what are the historical trends? And also, where are the biggest opportunities and where are the biggest issues and the biggest risks? You get all that stuff. Then, once you know that unit economics on creating pipeline and GRR are the two biggest problems in your business, then you can start going and looking at attribution and individual investment analytics and breaking it down by segment and all the things that you can do to figure out what are we going to do once you have the context around that GRR and this are happening. When companies currently do this with the bottoms-up reporting, that context doesn't exist for the people that are doing the analysis and making the reports. The person that's making the demand gen report does not know and is not looking at the data knowing that your GRR is 81% and it's the biggest issue in your company. Their report has nothing to do with that. Their strategy has nothing to do with that. That's an issue. For the people that are building other reports that come bottom up, they don't understand that the unit economics around creating pipeline are the actual biggest issue. The person that's doing Google Ads doesn't know that. And so when they're doing Google Ads and they're putting together the report, they're not looking at the Google Ads expenditures or the ROI or anything with the lens of we're not creating enough pipeline for our investment at this stage of the process. And so the bottoms up reports, what happens? Everything is just sunshine and rainbows from the bottom up. Every program's working, the influenced revenue model, our events are influencing revenue. So many people love our brand from the trade shows. Our MQLs are on track, And at the top level, growth rate slowing down. CAC is at 3-year plus CAC payback. Unsustainable financial performance metrics that are either declining or stagnating. And we need to figure out how to put those together to actually fix things. I guess the point that I'm really trying to make is that the KPI should tell you how you're doing, not attribution. And when we strip out attribution from the KPIs, it creates a far more objective view at the executive level about where are the issues in our company, where are the issues in our revenue factory. It's a much better way to put it. I'm encouraging people to start with KPIs. You need performance KPIs and you need cost unit economic KPIs. You need both sides of the equation. You can then use those to feed into the base 2025 model. Just play out the same trends and the same stuff that's happening for this year from a unit economic standpoint and an efficiency standpoint. Play it out to next year. See where you would end up if you change nothing. Then start to put all the other things in place. You can run this in a tops down or a bottom up framework. So you can say, we need to get to 30% growth. What needs to happen to get there? Or you can say, here's what happens if we do nothing. If we add certain things, here's the outcome. Where do we actually land? How does that compare? You can go in both angles. So I believe that, and then from there, then you start getting into custom crafted plans about how we're going to invest certain things in terms of headcount and programs. And that's where you start looking at attribution. Recommendation, I'm sure as 2025 planning heats up with our customers, I'll have a lot more insights on some of the the common missteps and roadblocks that happen in 2025 planning. So we'll get more into that. But if people are like thinking about it, have questions on that, or working on it right now, would love to take questions about KPIs and attribution, or annual planning, quarterly reforecasting first, and then we can go from there. Thanks everyone for being here.
Sounds good. I have a question. So how would you suggest to kick this process off? It suggests that this is really at the executive level. So should a company share the KPIs through the executive level first, and then that get shared with the senior leadership team? Or how do you recommend to go about this as a CEO yourself?
So if you look at this at a high level, what you're doing is you're doing what your FP&A team does for the business, but you're translating that process specific to go to market. So when you think about FP&A, what is it? Financial planning and analysis. And so typically you start with the analysis, even though it comes at the end, FP&A, the A is actually the first place that you start. For a business, the recommendation of how to actually implement this is step one, to be aware of the KPI, get the KPIs measured and be aware of them at the executive level and understand the historical trends. Just don't change anything about anything that people are doing. Just be aware of what's happening and get other people thinking about this is how it's calculated. This is how my outcomes drive this metric, and get people just thinking about it. Then step two is, once you've had a couple of quarters of looking at it and looking at the trends of it, then you can start to figure out, how are we going to integrate this into our planning? Then the next step would be, how am I going to integrate this into how our senior leaders are incentivized or what they're goaled on? Then it would be, how do I roll this down to my VP and director level layers? And to be honest, like I got to see how this plays out a little bit longer. But there's some parts of me that think that a director never needs to see this data, that this should be managed by executives, and that the KPIs that come down from that, it should be more focused on what those people can control, and and it's the job of the CMO and the VP layer to translate business level metrics into individual contributor or like sub-functional level objectives.
Awesome. Super helpful. I'm going to bring on Duke. He has a question.
So what are the KPIs that are the most important to look at and measure?
Let's do it. Sydney, I don't know if you have that deck. Duke, we presented some of this stuff last week, but I love going back, especially on these concepts. So happy to do it. So we'll just talk through at a high level, like the metrics stack. Thanks
for confirming on LinkedIn this morning, too, of the book. I appreciate it.
Yeah, happy to do that. Glad you made it here. And this is an excerpt from that book. And this is something that we're adapting. For instance, I don't agree with the like CAC to LTV and this being the primary efficiency metric at the top, but that's beside the point. At a high level, you have your investor and financial metrics, which every CFO, CEO, and board are looking at. You think about net new ARR, total ARR, growth rate, sales and marketing efficiency, CAC payback, rule of 40, free cash flow. Like, you can get all this. The CFO is going to report on all that stuff quarterly once the company's above like 5 million in revenue. Everyone's looking at these numbers, or at least some form. It might be a different metric, but it's basically getting to the same thing, right? So you have those. Those are the metrics that are really the top level. And so what companies see right now is they can see like growth rate is slowing down, CAC payback period is going up, our costs are inflating, our growth is slowing. We have an issue at the highest level. But then when you try to break it down and go into it, there's no process to take all the financial data with the CRM data and put it together and say, okay, our growth rate's slowing down. Let's methodically break it down and figure out why. That's what's missing. And so with this KPI stack, you basically have very high level compound metrics at the top that all CFOs and CEOs are used to seeing, and board members, and then being able to translate that down into the CRM metrics. So you can look at growth rate, know that growth rate is comprised of these three metrics, look at those three metrics, then know that those are comprised of these three metrics, continuously break them down and identify, we have an issue in the unit economics around creating pipeline, for instance, or we have an issue around, our biggest issue is actually gross revenue retention when you think about our growth model. And so this framework just allows you to break that down to combine revenue data, expense data, and CRM sales progression data all together to create this form of KPIs. So you can see that at the bottom level, there's like a data model. Salesforce has a standardized model that's built in, and you have opportunities and you have certain objects and there's certain data collected like the day the opportunity was created and the day that opportunity was closed. So every company has some form of a data model already in their CRM, whether they intentionally chose it or just used what came out of the box in their CRM. And that in order to get to this level, you basically need an enhanced data structure inside of your CRM, and you need an enhanced data structure inside of your accounting system that allows these two data points to be connected together, or data sources.
Got it. That's great. Thank you.
Hi, good afternoon, good evening. I'm on my evening walk in the southwest of England, so apologies for camera off. I know you've touched on this before, and you've always come up with the most logical answer, Chris, about publishing pricing for B2B SaaS. And although it sounds beautifully eloquent and logical, why aren't I seeing people adopt this widely? Because I've been on about 3 or 4 vendor calls in the last week or so, and nobody publishes their pricing. And I find that very bizarre. And we sell B2B SaaS ourselves, and I'd like to publish pricing, but I can't point to other examples in our industry to the CEO and say, look, these guys are doing it, these guys are doing it. And our CEO is afraid that we're going to put our necks out and look silly or whatever. So it'd be good to know your thoughts on that.
I think that as a business, if you have confidence in your product and confidence in your offer and confidence in the ROI that you deliver against that offer, that it's very easy to put your price on the website. I think that companies that think they're going to be undercut by competitors or don't actually think their product is as valuable and they need their sales rep to prove the value or other things like that, make it easier for companies to retreat and hide behind the pricing in hopes that more people will talk to them so that their sellers can pull the artisan gymnastics and close some deals. And so to me, it really comes down to the simplicity of the offer and the confidence in the offer from a business. If you notice at the Paceto website, Paceto has been officially in business for 8 months and we do not have a pricing page. And it's because we haven't fully figured out our pricing and packaging. Who would have thought? That once we can figure out, okay, these are the things that we sell, this is how it gets packaged, this is where it gets priced, this is what companies will pay. Once that stuff gets figured out, it will immediately flow onto the website for us because it's just helping a buyer buy, and we're going to have confidence in those levels of offers. And so for any company that's at 10 million in revenue or above, there's really no excuse for this anymore. You have an offer, you've chosen pricing and packaging, you've sold it to enough people to get 10 million in recurring revenue. Enough different people have sold the deal to get you that far that I don't think there's an excuse for it anymore. Now people will say, oh, our offer is too complicated, or we're going to customize it for every customer, or we have to do X, Y, and Z. And like, if it's complicated, you can also say starts at $8,000 a month and goes up from there based on these factors. You could ask people certain things, or you could tell them and give them a base range. To me, this, I don't have a lot of passion for this debate any longer because it's just opinions and a lot of fear, honestly. And so while I'm happy to like communicate the facts, like the reality is the facts don't matter. If the facts mattered, then people would do it. The fact that every customer wants to know the price before they talk to your sales team, if you asked your customers, you would get that data. That people want to be able to understand and put it in their budget before they engage in a sales process. They want to understand how you compare in price to other alternatives, just like they do when they shop a car or a house or anything like that before they go on and go and see a tour of a house or go to an open house. They want to at least know the fucking price before they spend their Saturday going to the house. That I just think that the logical reason is that you should at least be able to put a starting point or a range, or you should be able to put your exact pricing model. And the reasons that companies don't do it are not logical.
Thank you. I totally agree. And if you don't mind, once this is put on YouTube or in a podcast, I'm going to send this snippet to my CEO if that's all right with you.
Okay. Happy to deliver that news.
Thanks, Chris. Bye.
Bye. Have a good walk.
Okay, we do have another question about segmentation when it comes into the planning process. So you touched on this a little bit in your intro, but at what point do you then go into the segmentation modeling? This person said, I've traditionally done this when we get into the bottoms up, tops down comparison. And it's the, how are we going to get there? Okay, now let's start breaking this up by segment and understanding where we're going to place our bets. What would you recommend to bring in segmentation into the order of operations for planning?
So one, it depends how you define segmentation. So when you think about the go-to-market motions from no touch, low touch, medium touch, high touch, and dedicated touch, you're basically, as you move down the motions, you're increasing cost, you're increasing complexity, and you're increasing deal size in order to support that increased complexity and cost. So the motion that you're going to run to acquire Coca-Cola for $1 million a year is very different than to get a two-seat SMB customer on $10 per month per seat. They're going to be very, very different motions overall and different cost structures. And so when you break down a company's revenue model, it is basically the sum of individual production lines. So you have even if you don't think about this differently in your company, you just think you run an inbound demand gen motion and that you get, this many of your like tier 2 or mid-market accounts, and you get this many enterprise accounts, and you get this many SMB accounts, that subconsciously you're putting more effort and expenses on the enterprise customers in the sales process, and you're not doing that for the companies that have 3 seats. And so you're actually creating different ones. Now, let's say you get 10% of your revenue from enterprise, and let's say you run a medium touch motion and you get 10% of your stuff from enterprise, 70% from your SMB mid-market, and then you have 20% from this like micro customer that you just try to close on like a low touch self-service type of motion. That adding those 3 things up gets you your total revenue. You have your micros, you have your SMB mid-market, and you have your enterprise. All 3 of those things combined, you get your total revenue. Then you could look back and you could look at the historical trends of the enterprise growth. You could look at the historical trends of the mid-market growth and the micro, and you could see, is one of them growing a lot more year over year than the other? Is one of them slowing down? Something like that. What a company would find if they did this analysis most of the time is that they get 10% of their revenue from enterprise customers, but they don't really have an enterprise motion. That they're just getting lucky as some enterprise customers funnel through their inbound AE SDR motion and they get some customers that way. But in order to really like scale and grow that, they're going to need a dedicated team. They're going to spend more time in person. They're going to spend more time with personalization and exec relationships. Maybe they need partners. And so when you think about segmentation as segmentation across the different production lines in your factory, SMB, enterprise, however you do it, then segmentation makes a lot of sense. When you start to break it down by vertical or geo within a production line, it starts to get very complicated. And so I think that there's a variety of ways of segmentation, but the real primary segmentation layer has to be customer lifetime value driven. And customer lifetime value then would drive, okay, how much can we spend to acquire that customer? And then where are we going to go on that motion? And planning by that level of segmentation first, I think, is the best bet. So that's where I would start. I'm sure there might be some follow-ups. I'm happy to keep going on this one because it's interesting.
Yes, it's definitely complex. This person can't come off mute, so they're DMing me. But they said that they primarily sell to SMB mid-market, SaaS, same motion coming in, same lead flow, same amount of touches per customer. So essentially same production line, I guess. they are struggling with their superiors of trying to forecast out the industries by who's going to source by an attribution metric, right? So industry by who's bringing in those industries. Is it marketing? Is it sales? Is it SDR outbound? So would your recommendation be to remove that, or what advice would you give?
Let's play out this example, right? So you have this like inbound motion where you have all these marketing expenses, you do one-to-many advertising, you have an SDR layer and an AE layer, and you're closing some segment of mid-market deals that are $40K a year, and then you have your SMB deals that are $4K a year, and you're running that through the exact same production line, except for when you close one customer in SMB, you get 1/10 of the revenue that you do with a big customer, but the costs stay the same. That if you can't philosophically find a problem with that, just at a high level, then there's a big issue here. Like 4,000 ACV doesn't even pay for the SDR headcount cost. There's no way you can run that full motion with marketing and SDRs and website costs and events and a salesperson commission. There's no way you can run that motion for a 4K ACV deal. Those companies are going to burn to the ground. So you can't do it. You need one person selling the deal and a highly incredible organic marketing engine to sell those types of deals. And you have to sell them in 7 days, like ideally one call. It just doesn't exist in SaaS. The motion that you run to close a 4K customer fundamentally has to be different than the one that you use to close a 40K customer. Fundamentally needs to be different than your 400K customer. And when you mix them all into one, all you're doing is you're getting lucky in the enterprise for deals that are just happening to flow through a motion that isn't built for that type of customer. And you're destroying yourself on the low end, running an SMB customer for 4K a year through the same motion where your CAC is going to be 20 to 50 grand. I don't know if I answered the question specifically, but we really need to be thinking about these as different lines. And if you're 8 million ARR and you have an SMB, a middle market, and enterprise motion at 8 million ARR, you should probably think about only having one. There's probably one that actually delivers most of the value, and the other two are in there just making everything more complicated. You should strip those things out, figure out how to make one really work, get to 20, add a new one later. So I think that motion complexity was used to drive growth faster in the era of growth at all costs. But now that we're not in that era anymore, like adding new motions just creates a less efficient overall machine. Instead of running one thing that works really well, now we're running 3 things that kind of work.
Yeah, this person basically said that their segments are fake segments because their ACV is only like 25K for SMB and 30 to 35 for mid-market. So it's just kind of essentially just number of seats, really.
That is,
and so the segments is not really aligned to a different touch of emotion in the factory. It's essentially one factory. They're just have this firmographic data that they're laying on.
The differences in customer value should be 3 to 10x higher between segments. So if your SMB customer is 20, your mid-market customer should be at least 60. And if your mid-market customer is at least 60, your enterprise should be 180 or more, and your strategic should be 500 or more. And so you can see, like, you really need big differences in customer in first year ARR and in customer lifetime value, because at increasing complexity in the motion increases cost by minimum 2x. So if you're going to increase cost by minimum 2x, you need at least 2x out, but you probably want at least 3x out in terms of return. That gives you a 3x baseline. So like if your SMB customer is 4K and your mid-market customer is 8K, that's not really doing a lot of service to your company. When we get on with Jocko on September 10th, and maybe I'll do a little preview of this next week, we'll talk through the production line concept and how the growth model is basically just the summation of 3 different production, or however many production lines you have. And the separation of the costs between SMB and enterprise is very, very difficult, but segmenting what customers are flowing through your factory is very simple. If any company that has the data can tag the customers and look at the flow of, and most companies are doing that already, especially closed won customers. So that can help with planning and forecasting too.
Okay, another question. This person's driving, so we don't need any
Driving,
accidents
walking.
today. This is an active episode here. But so the question is, they are trying to improve their go-to-market efficiency and using some of the go-to-market efficiency ROI metrics that we've talked about in the past in previous episodes. So they know they need to reduce budget, but they also don't want to reduce budget too much and want to reallocate the actual budget specifically on paid-in events, on the event types, the paid channels. So if they reallocate, their sales cycle is about 90 days. So how long would you suggest that they kind of monitor the reallocation and if the reallocation strategy is effective or not?
Do you have that formula? It is the sales and marketing efficiency percentage equals the amount of money that we spent on total go-to-market divided by the incremental ARR, which is new logo plus expansion minus churn minus contraction. So you have incremental ARR on the bottom, total go-to-market cost at the top, times 100%. The higher the number is, the worse the performance is. That ideally, in the golden days of SaaS, a public SaaS company would be at 140%. Today, they're at 200 to 250%. The lowest performing SaaS companies in the public markets are somewhere between 400 and 500% numbers. So you do get a sake of the thing. Now, if you want to keep that top number the same, that means that you need to double the bottom number. So, or if the top number is staying the same, that means you need a significant impact to incremental ARR. So if you're at 300% right now and you need to get to 150% because that's what the public median was and that's your target, that you're going to spend the same amount of money and you need double the incremental ARR. If you're on a 90-day sales cycle, I think that the odds of that playing out is probably going to be 4 to 6 fiscal quarters to make that type of improvement. And for most companies, that's not an acceptable timeline. And so what you get left with is, if our numbers are bad enough, we need to lower the budget. There's no way around it. I hate to be the bearer of bad news, but the math doesn't lie. And so I have consulted with companies that literally in the sales process, they're like, we do not want to reduce our budget. We're trying to figure out how to spend more money. And then you go through the analysis and you say, your sales and marketing efficiency is 400%. There's no fucking way that you can spend more money. You're spending 2 to 3 times as much as more than you should right now. And to just turn the conversation around. So one, if you want to just do this through efficiency improvements, the delta has to be close. You can't be far away. If you're trying to get from 220% to 180% over the next 4 quarters through continuous improvement, you could probably do that. But if you're at 400%, you need to get to 200%, which is 2x efficiency across your entire go-to-market spend, which could be $50 or $100 million. It's just not, you can't easily correct that. I think in most cases, if your gap is small, continuous improvement, improve conversion rates, reallocate spend, try new programs, just ongoing optimization, incremental. You're good to make small jumps there. When the gap is big, you have to cost cut. If the gap is big, it means that things that you're doing are delivering very low ROI or no ROI. You have to cut those things out, take a big chunk out of that number straight away, and then do the same thing that you do in the first step. I guess in that case, you have 2 different paths, but it's all dependent on how big the gap is. And we talked about that last episode as well. Your plan of how you look at the analytics and what you're going to do is going to be very different if you have to double the ROI of your 50 million versus get 1.1x more out of all of the money. The way that you look at it and the things that you do are very different depending on that gap. It's the difference between incremental continuous improvement and some type of transformational or breakthrough change, or moving $5 million from one thing to another, or cutting 5 million. I think that a lot of people are against the idea of cost cutting. I remember that at some point in my career, I was also against it. But in this era right now, the reality is that the financial metrics do not allow us to spend the money that we're spending right now. If we were the owner of the business that we work in and our company was spending $4 in sales and marketing to get $1 in business, that with gross margin adjusted, the customer has to stay with us for 8 years to just before we even make a profit. We have to take care of this customer for 8 years before we make any money. That if you ran that business, you would cut costs too. And so I think we need to be a lot more objective around the idea of cost cutting. There are many situations where it just has to happen. And we shouldn't shy away from it. We should let the business data and the business metrics tell us what we need to do. And if that gap in sales and marketing efficiency is really high, it tells us that we have to cut expenses if we want to get this number in line in some reasonable period of time, which most companies are in. And the ideal thing, get rid of the big expenses that don't deliver ROI, get that number from 300 down to 220, and then make incremental improvements from 220 to 180 in the next 4 quarters.
I think a key call out is the timeline. This doesn't happen in 30 days or a quarter, especially if you're making larger adjustments to the business. They take time to play out. I think everybody wants to make an improvement the very next quarter, which you might be able to make a small improvement, but maybe not what your actual goal is.
Yeah, the leading metric to that would be like the unit economics around pipeline creation. But another thing, when you think about like the timeline's super important, and when you think about sales and marketing efficiency, but 3 of the 4 numbers that make up incremental ARR are existing customer metrics. And so for some companies, like, it doesn't matter how much growth you have in new logo business. If your GRR is 85% and your NRR is 92% and you're churning out customers left and right, that your new logo engine is not going to be able to keep up with that over a certain period of time. And so it's just about having the vantage point that that number is impacted across the entire factory, not just in the things that we do in marketing to create pipeline and do that more effectively can improve that number. It can help that number, but it's not the sole driver to fixing that metric.
Yeah, great call out. We had a clarification or question from Duke.
So when you were talking about the go-to-market efficiency, what did you include in the go-to-market spend? And I was just wondering, does that vary by company, or doesn't matter, set factors that are almost always included?
Every individual company will categorize they don't really think about it this way. So they'll categorize it however they are looking. Some companies will put customer success and cost of goods sold. Other ones will put them in sales and marketing. Some companies will put the national sales meeting not in sales and marketing. They'll put it in like HR events, and then therefore that $3 million in sales and marketing won't hit their CAC. So and whether they're like doing that objectively or they're trying to manufacture their CAC number, either way, like, it's not consistent, right? And so what we're hoping to do at Paceto is create both definitions and third-party analysts that go through and categorize the expenses that sit out of the organization. And so when we look at it and we see national sales meeting, we say, okay, all your salespeople are there, you're doing training, you're bringing people together. That is a cost of running your go-to-market. That $3 million goes into your sales and marketing efficiency number. But at a high level, all of the headcount and programs you use to close new logos, so sales headcount, solutions engineers or other types of specialized resources, business development headcount, technology and tools, the CRM, the marketing automation, the outreach platform, the ABM, the deal desk, the other 10 sales tech tools like Clary, all that stuff. You have the marketing headcount, you have your agency and consulting costs in marketing, you have all the program dollars in marketing, events, advertising, PR, analyst relations, content, all that stuff. You have customer success and professional services. You have account management. You have Gainsight and all the other tools that people use on that side. You have the operations resources, so the sales ops people that are calculating the comp plan, the Salesforce admin, the marketing ops people, the outsourced resources that you use for that, the sales enablement team, the product marketing team. There is an exorbitant amount of costs that go into the go-to-market machine. And so that becomes the baseline number. The top of that division equation is all of that stuff combined. And then you have the incremental ARR that you get. And so you can see when you think about all of this that like if we have a $4,000 a year customer, it's pretty hard to make all those costs make sense to have a $4,000 a month or a $4,000 a year customer. But so at a high level, would be all of those things. Anything that's not in cost of goods sold or that falls into general and administrative. So that would be legal, HR, finance, product development. So nothing that goes into COGS, nothing that goes into G&A. Pretty much all the stuff left over is going to be sales and marketing, or what we'll call go to market for clarity.
What was the ideal percentage or rate?
There's really no such thing as an ideal percentage. The conventional wisdom would say 100%. So you spend that much money, you get a 1-to-1 ratio back on recurring revenues. That would be like the 2012 what people published. What I can say is that the median of public SaaS companies in 2021 was 140%. And the median of the 80 public SaaS companies today is somewhere between 225 and 250%, which means they spend $2 to $2.50 to get $1 back in incremental ARR. The conventional wisdom of if that number is greater than 200% for 6 consecutive quarters, then your business and revenue factory is now considered entirely unsustainable. And so most companies have now reached that point. Slow down in 2022. You have the full year of 2023 and half of 2024 playing out. That most companies are coming to the realization that that number is above 250, 300%, and it's not going anywhere. And now it becomes a full-on business level issue.
Got it. Thank you.
Just like my observation so far, not hard data backed, is that the issue is worse in private companies than it is in public companies. So the public SaaS medians are better than what you would see in most privately owned SaaS companies.
Is it because they're able to hide behind being private? Or why do you think that is?
It's not really about the hiding. I think that there's somewhat of a selection bias that, like, in order to become publicly traded and these things, that most likely you have developed an efficient go-to-market motion. So there's like some level of a selection bias that happens, that the people that get there obviously have better metrics than the people that haven't gotten there. And the second thing is that there's a lot of private companies that through the growth at all costs era skipped the unit economics step and just used a 20x revenue multiple and funding rounds every 18 to 24 months to just ignore that their CAC payback period was 5 years. And then when the funding dries up and the revenue multiples go from 20x to 6x, that train runs out of the station. Now you're stuck at 150 million ARR with a 5-year CAC payback, and you have to fucking slash across the company to try and get it back fixed. And so a lot of companies in the 75 to 250 range just skipped the unit economics step based on the good interest environment. And now they're in this stage where literally they can't IPO, they can't raise another round, they're burning a ton of money, they have a significant amount of costs. They can either hope that they can get through it, or they have to just like dramatically adjust their expense line items. I think the funding environment, and now we're feeling the aftermath of the funding environment, is the root cause in private companies. If the funding environment didn't exist, it would have forced more financial discipline, but that's what happened.
All right. I think we're good to wrap up on that note.
Cool. Thanks y'all for being here. We'll go through the factory production lines next week. I'll commit to getting that done. So we'll go through that, and then we'll have an initial look at that. And then on September 10th, Jocko will be here. He actually wrote this book. So wrote the book. I believe in it a lot. We'll share a lot of that stuff, and you'll get to learn directly from him and ask other questions that might be more nuanced or detailed. So him and I will share in that event, which will be really cool. Again, that's coming up on September 10th. You can register. There's a link to register for it on pizzetto.com. You can click on events at the top and go from there. Thanks y'all for being here. We'll be packing a good punch next week. I hope you all have a great rest of your week, and we'll see you again soon. Thank you.